September retail sales numbers out this morning at 8:30 a.m. Eastern. Economists are expecting sales to rise 0.3%. This after October sales missed expectations. Want to bring in Franklin Square CEO Michael Forman with $17 billion in assets under management, largely credit assets. Michael, good to see you. Thanks so much for joining us. Let's first talk about the Federal Reserve. Did you position yourself differently going into this December 16th meeting where everybody's expecting the Fed to raise rates?
Right. Well, certainly we're all expecting rates to go up. We manage $17 billion, mostly of credit assets. So our assets are floating rate assets, so we won't have the same shock that fixed rate assets might have. So we are positioned. We have been expecting it for the liftoff to start at some point. We think it will start. We think it will be gradual, but we think we're very well positioned. Our public fund, FSIC, has about $4.5 billion of assets, pays a yield of about 9%.
Wow.
So very high yield,
nice yield
in this marketplace in floating rate assets, so we won't have the pressure that the fixed rate assets will have.
I feel like you need a yield like that in order to attract money these days. You speak about a shock. Let's talk about the shock of Third Avenue. Third Avenue, this mutual fund, borrowing withdrawals from a high-yield bond fund while it liquidates, a sign of the severity of the junk bond plunge. And, Dagen, you made the point this is the first mutual fund that's actually closing its gates?
The first mutual fund, according to the Wall Street Journal's terrific reporting, as always, to ever cut off redemption, say you can't have your money. That's what this fund did, and they didn't get SEC authorization to do that. First time, at least on record, that this has happened. What kind of panic, potentially, does that cause among individual investors? Because when they all start running for the exits at the same time, well, asset prices collapse.
And no liquidity.
Right. Well, a lot of things there, right? Certainly it shows the risk in an open-end structure where managers have to manage to redemptions. And if you look at the market today, we've seen a significant sell-off in any commodity-related credit. So it's not just oil, it's all commodities, and it's triple Cs. It's risk-related assets. So it's really a risk-off trade. So folks will see redemptions. We are in a closed-end structure. So what we tell our investors is invest for the long term. As long as we as managers don't have to manage to redemptions and liquidity, you can do well. There's lots of opportunities in the marketplace. We believe the volatility creates opportunity. But if you're in an open-end structure and folks are looking at taking some tax losses before year-end or rotating out of fixed-rate assets into floating-rate assets, you have risk. And certainly this is the first one you'll see. There'll probably be more. You'll probably see heightened redemptions as we go toward year-end. But from our perspective, we're happy to invest for the long term, invest in floating rate assets. We don't have the same risk that a high yield fund might have.
You will admit, though, bar on the door on a retail mutual fund is scary.
That's a big story.
There's no question. Certainly you saw it in the hedge funds, for example, back in '09. And I think that actually worked out better for investors. So what the manager's doing is they're looking at the marketplace. There's no liquidity. If you look at the impact of the Volcker rule and banks not acting as dealers, there's a lack of liquidity in the marketplace. So you're a manager and you've got to sell. Do you want to sell into a depressed market? And by the way, there may not even be a buyer on the other side. So the manager, I'm sure, did what they thought was in the best long-term interest of investors. And while it would create some panic, probably the right move in the long term. You do have to look at the long term rather than the short-term impact.
John, you guys put this as the #2 story in What's News this morning in the Journal. You think we're going to see more of this?
Well, I mean, the significance of this is what Dagen points out, that it's the first ever that this has happened to, and it's in a zone that people have been warning about for quite some time, the high yield zone. The connection that you made with commodities, we should probably explain this, is that a lot of these high yield loans were to oil companies, and that is kind of now cascading through the market. As commodities drop, these loans are riskier. Is that what the point you were making?
Yes, and we manage a fair amount of energy assets, and certainly after OPEC's announcement last week, there's now, we're seeing a decline again in the commodity price, and you're seeing loans gap down 20–30% as well as high yield. So it's certainly a distressed period in energy assets and commodity assets, and I'm sure that had a great impact on Third Avenue and will have an impact on lots of the high-yield managers, I suspect.
So this follow-on effect, this knock-on effect of falling oil prices, you think continues to unnerve stocks?
You would think so.
Yeah.
You know, you would think going into year end there'll be a fair amount of
And
volatility.
Jack Goddard, you've been working on your look ahead for 2016. That's the cover of Barron's this weekend.
Yes, the 2016 outlook, and the managers, the strategists we spoke to are not incredibly excited about what they see ahead, as you might not be surprised to know. So 6 to 8% returns. They're pegging an S&P 2200 at the end of next year. So that's not a huge return, but it's better than what you're getting on cash.
I reduced to 8
after this year.
I mean, the economic forecast
I like 6 to 8.
2% and change. So
Yeah,
6 to 8
exactly. So
in
you
that
got
kind of
a slight
environment, you know,
PD
is-
expansion,
I like it.
Yeah.
maybe 5% growth in profits. You know, there's this huge, and I want to ask you about this, if I may, Michael, this huge dispersion between what's going on in the energy world and everything else. And what I wonder is, okay, Third Avenue is killed by their energy bond exposure, but does this spread to other credits, high yield junk bonds, but not in the energy space, or is this isolated to energy?
I think, as I said before, it's really a risk-off trade. So certainly if you're a triple C, certainly if you're not at the top of the capital structure, I think you have more risk. I think it's a time of great uncertainty. So while our economy continues to grow at a moderate pace, you know, what impact will a continuing rising dollar have? What impact will all of the distress in China and in the emerging markets have in 2016 and beyond? I think that's what I'm concerned about. At some point, certainly the U.S. economy is performing better than everybody else, but it's a global economy right now, right? So
absolutely,
what's the impact of China? What's the growth rate in China? What's the impact of Europe? What's the impact of what's happening in the Middle East?
How do you protect yourself? What changes do you make going into 16?
What we try to do is be defensive. We want to invest for the long term. We try to tell our investors that you can't look at 1, 3, 6-month horizons. You have to look at the long term. We're in credit, so we look at senior secured credit. I'd rather be at the top of the capital structure than equity. I think a lot of investors, if you could lock in a 6 to 8% return for 2016 right now, would do that. We're going to do that by paying a yield. I think if you talk to whether it's retail investors or institutional investors, everybody's looking for yield right now.
Yeah,
we provide yield, we provide a level of safety, and we provide floating rate assets at FSIC. So we think that's a real advantage in the markets right now.
All right. Hey, 9% yield. Pretty impressive. Michael, good to see you.
Thank you.
Thanks so much for joining us, Michael Forman. And of course, Jack, we'll talk more throughout the program.
Great.